my name is Natina Poinde. I am in your Finance 403 corporate finance class, and I'm doing a research analysis on two companies. My main company is Hilton Worldwide Holdings and Marriott International Incorporated. So the whole purpose of this research paper is to look at trends, financial trends, and to compare it to compare it from a company and its industry standards. So I took Hilton and I took Marriott. I looked at Hilton's financial ratios and measurements, and I compared it over a 5-year time period. I looked at a time series analysis, and then I did the same for Marriott and crossed them to a cross series analysis, just to see as far as where Hilton is financially and its well-being compared to another company in that industry. So just a quick introduction to Hilton. So Hilton Worldwide Holdings was incorporated in 2010. It's in the industry of hotels and motels. It's exchanged in the New York Stock Exchange with the ticker symbol of HLT. One interesting thing that I found was that Hilton has about 35 shareholders, and it's kind of weird because compared to its competitor Marriott has a number of shareholders compared to it as well. Hilton is found all over the world in different countries, over 104 countries and territories. They have almost 5,000 hotels that are open. And some of Hilton's key executives are Jonathan Gray, who has an extensive background, who's really experienced in real estate. And you have Christopher Nassetta, the CEO, Jacob James, the CFO, and Matthew Sawyer, who is the Chief Officer of Human Resources. And these are just a few of the executives to name out. And then you have the competitor of Hilton, which is the Marriott. Marriott International is traded under MAR, and it's under the National Market System. And it was incorporated in 1998. So going back to what I was saying about the shareholders for Hilton, Hilton has 35, while Marriott has 37,000 shareholders. And this can really come into play when looking at the different trends for the shareholder shareholder return ratios. And some of Marriott's key executives is actually J.W. Marriott. Didn't know he was still alive. It's like 85. And you have the CEO, which is Arne Sorensen, corporate secretary, Bancroft Gordon, just to name a few. And so now I'm just going to go over my Excel document and explain that and just give a quick presentation. So looking at our financial statements here for Hilton and our financial statements for Marriott, we are able to look at some of the financial measurements. So again, the purpose of this project is to evaluate a company based on its trends and through financial ratios over our 5-year time period and examine them against its competitor. So here I'm just going to give a brief presentation of my ratios and of our cross-series analysis. So looking at Hilton, let's start with our liquidity ratios. So here we have Hilton's current ratios. And if you click on here, you can see that we have our current assets divided by our current liabilities. And let's look at our cross-series analysis and compare it amongst each other. So scroll up our liquidity ratios. So here you have Hilton's, and here you have Marriott's. So most investors will most likely look at the liquidity ratios of a company. So liquidity ratios are just a measure of a company's ability to pay debt, responsibilities through your assets and through your long-term commitments. So again, looking at our current ratio here, Hilton being the blue line and Marriott being the orange. So Hilton it's like a slight decrease and then a major decrease by 2015 and shoots up, while Marriott is kind of at like a constant decrease here. And basically your current ratio shows that, it measures a company's ability to pay short-term and long-term commitments. And looking at our other liquidity ratio here, quick ratios, it just gives you a sense of a company's ability to pay off its current debt without inventory. Because here you have your current ratio, again, is your assets divided by your liabilities, but your quick ratio would be your current assets minus your inventory divided by your liability. So furthermore, let's scroll down to our activity ratios. So activity ratios are just the ratios and measurements that show how effectively the company is managing its assets. And I use the 5 ratios here: accounts receivable, inventory turnover, total asset turnover, fixed asset turnover, and days outstanding, or the average collection. And so one of the important ratios that as an investor that I would look at is the accounts receivable turnover. And an accounts receivable turnover shows how many times a firm pays off its average accounts receivable within a given year. So here you have Hilton with a increase, and then a decrease by 2016. And Marriott is kind of just, always constantly behind here in this measurement. So moving along to our profitability ratios. So here, profitability ratios is something that I know investors will look at because it, tells how profitable a company would be. And so the ratios are used to assess a corporation's ability to produce earnings as compared to its expenses and other related costs during, whatever time period. And again, or one of the most important measurements, there's actually 2 looking at this. You have return on equity. And your return on equity is just, it measures the return on common equity and the company's ability of earning return on their equity investments. So it's basically an investor investing in the company and wanting to know what they would get in return. So again, you have Hilton in the positives. So this is good. So you have Hilton at a constant rate, and then it shoots up by 2017. And one of the amazing things is with Marriott, it's in the constant negatives, but again, here you see a major increase by 2017. So another measurement, I guess you would say, is looking at your price earnings. So your price earnings ratio is just a measure that shows how much an investor can anticipate in a firm in order to collect $1 of that company's earnings. So again, it's something that the investors look at because they're trying to get a return. They're trying to see how much money they can get off of what they put in. So here you have Marriott. It exceeds Hilton here. in 2013. There's a major difference here. But by 2015, Marriott declines below Hilton's price per earning here. Okay, so going down to our debt management ratios. So debt management ratios are also known as leverage ratios. It's just a measure of financial leverage and a company's ability to avoid financial distress in the long run. So, and usually these ratios and measurements are usually used by banks and lenders just to see, the ability that the company has to pay back, So one of the most important ones is the debt ratio. And the debt ratio just gives you a comparison of your total debt to your total assets. Trying to see here. It gives you an idea of how a company may be using its assets and, wanting more debt, I guess. So here you have Marriott exceeding Hilton here, but not until 2017, where Hilton has made a huge improvement from 2015 to 2017, which is just 2 years later. And let's also look at the debt to equity. So debt to equity measures total liabilities to total shareholders' equity. So again, I know this is very important to an investor. You're just seeing how much, or not necessarily an investor, but just someone that's lending out. So you're just saying, okay, the borrowed funds versus the funds that your shareholders are giving you. So here you have Hilton in the blue, and then you have Marriott in the orange. Marriott is in the deep hole here, only because you would have more equity than your borrowed funds. So that means that their investors, their shareholders, are giving a lot into the company. And again, you still have that number of shareholders coming into play, 35 to 37,000, right? Okay, so let's go down to our shareholders' equity. So here, an important ratio or comparison would be the cash flow per share. So basically, looking at the cash flow per share, it's just a ratio used to compare a company's market value to its cash flow. So many investors will look at, the income or the inflow of how much cash is coming in, and just comparing it to the value of the company on the market. And you just have Marriott here increase, and then a straight decline. So it's pretty stagnant here for Marriott. While Hilton, you have a slight decrease, but the decrease is constant. It's kind of predictable. So that's it for our cross-series analysis. And again, the time series analysis can be found here as well for Hilton. All right, so now let's look at our accounting measures. So the accounting measures just are calculated in different terms like money, labor, hours, and all that good stuff. It's an analysis of economic and financial activities of measurable components that are used to compare accounting data. So the measurements, you have total net operating capital, operating working capital, operating profits after taxes, free cash flow, operating cash flow, return on invested capital. Then you have your return on or your market value and your economic value and your gross investment. So here, let's look at the total net operating capital. So Total net operating capital includes all your fixed assets. You got your plants, your property, and your equipment. And it also includes your accounts receivable and inventory and so forth. And it just represents all the non-current and current assets used by a corporation in its operations. And so you have Marriott here, constant decline, and then a drop by 2017. Whereas in Hilton, you have, constant growth, or constant decline, but by 2017 to 2016, just a year later, it shoots up and then, kind of flatlines here in 2017. And so these just are measurements that you would just look at to just see and examine, accounting wise. Again, you can go to your incomes, the Hilton page, and scroll and click just to see how it was calculated. So we have our EBIT, and then we have it multiplied by our effective rate minus 1. Okay, so let's go over to the cost of capital here. And so our cost of capital is just to give investors, an idea what to expect and how the company generates return on capital. And so here's just a cost of capital on Hilton. So you have your after-tax cost of debt. And it's just calculated by taking your expected long-term rate times your effective tax rate, which this is found. You have to do a little research to find this. And then you have your tax rate minus 1, and you have to multiply it to get your after-tax cost of debt. And then you do somewhat of the same for your cost of internal using CAPM. So you have to find your risk-free rate, your beta, and your market premium, and you take your beta times your market premium plus your risk-free rate, and that gives you your cost of internal equity. And then you have to do a little bit more for the dividend valuation. So to get this, you have to take your dividend 2017 divided by your stock traded plus your growth rate, which Hilton's growth rate was 0. That's what was reported. And then you have your external equity, which looks similar to your cost of internal equity of dividend valuation, but except for you taking your flotation costs here. And so you take your dividend divided all by your stock traded minus your growth or flotation plus your growth rate, which in our case was 0. And then to get your current capital structure, you have to take your debt and your common equity, which is found on your financial statements. And to get the weight, you have to divide your debt by the total, common equity by the total, and it should come up to 100. So you have 76% of debt and 23% of common equity for your current capital structure. And then to get your weighted average cost, you have to take your weight of equity, which is here, and then you have to take your weight of debt, which is here, and then you have to take your cost of debt. Your cost of debt and cost of equity, which we found up here, and take your effective tax rate, and you multiply them and add them to get your weighted average. And you can also take the competitor. Here's the competitor and compare it. They are pretty similar here. All right. So now that looking at these trends here, you can really see how looking, at the different uh, graphs and measurements of the two companies, you can really see how to compare them. So let's conclude. So, in a conclusion, the overall conclusion, Hilton is pretty profitable, and there is some growth potential. But you can also tell that comparing it to its competitor Marriott, there has been a difference in the values in the financial trends. But so just looking at Hilton and looking at its ratios and just the patterns of those measurements, you would have 1 year a slow start, but by the next year, in 2 years, it would have a major increase. So that's why Hilton does still have some growth potential in value. But and one other thing that I've noticed in some of the ratios, you would see in 2015 the ratio or the measurement would be really good, but by the next year in 2016 it would decrease. So I don't know why there's such a difference in just those 2 years. The companies that have been going bankrupt or a certain event could cause this, but I have seen that as a pattern. So overall, Hilton would be a good contender to invest in.